Emergency. Silver smashes $120 global. China hits 139 plus. Perth Mint stops. Orders, next stop, 150. January 29th, 2026. Silver just printed $120 per ounce in New York, while simultaneously hitting $139 in Shanghai. That's a $19 arbitrage gap. In a world where algorithms exploit 1 cent differences in microseconds, this spread is held for 48 hours, and nobody can close it. Perth Mint, one of the world's oldest silver refiners, has stopped accepting orders. Metalor has done the same. Shanghai vaults just lost 26 metric tons in a single day. That's 5.2% of total inventory. Gone. Overnight. When the physical metal can't move to close a $19 price gap, when century-old institutions simultaneously halt operations, when vault drawdowns accelerate 17 times above normal rates. The market isn't speaking. It's screaming. And what it's saying could rewrite everything you thought you knew about money. Welcome to Financial Rewind. If this is your first time here, let me be direct with you. We don't do entertainment. We do economic forensics. The kind of analysis that serious people who've built businesses, managed capital, weathered multiple market cycles, actually need. Now, I'm going to ask you something. And I'm asking because this matters. If you've been watching markets for 20, 30, maybe 40 years, if you remember when a handshake meant something and information wasn't drowned in noise, then you understand the value of a channel that respects your intelligence. So here's what I'd like you to do. Hit that subscribe button, not because I'm asking for a favor, but because you recognize quality analysis when you see it. The kind that cuts through the nonsense and gives you what you actually came here for. Facts, data, strategic clarity. And while you're at it, drop a comment and tell me where you're watching this from. Because I want to know. Are you watching from New York, London, Singapore, Mumbai? Where are the serious minds gathering right now? Let me know in the comments below. Now, let's get into what's really happening and why the next few weeks could determine whether you're positioned correctly or left holding promises that can't be kept. On January 29th, 2026, something unprecedented occurred in global silver markets, something that, by all conventional market logic, should not be possible. At 2:00 p.m. Eastern Standard Time, silver was trading at $120 per ounce on the COMEX exchange in New York. Simultaneously, on the Shanghai Futures Exchange, the exact same metal was changing hands at Y30, the $8.91 per kilogram. That translates to $130.25 per ounce. The same metal, the same day, the same hour, an 18.25 difference. In a normal functioning market, this gap would last minutes, maybe seconds. Traders would immediately buy silver in New York at $120, ship it to Shanghai, sell it at $138, and pocket the difference. This is called arbitrage. It's the oldest trade in market history. But on January 29th, 2026, this arbitrage did not happen. The gap remained for hours, then days, and nobody could close it. Why? Because the physical metal wasn't moving. The world's refining and minting infrastructure had begun to seize up. Perth Mint, one of Australia's most established precious metal refiners, released a statement that sent shockwaves through the industry. They were no longer accepting new silver orders, not delayed orders, not premium-priced orders, no orders at all. Within hours, Metalor, the Swiss refining giant, issued a similar notice. Then Argor Heraeus, then Valcambi. Europe's premier silver refiners were telling the market something extraordinary. They could not supply physical metal, not at any price. Delivery timelines that normally ran 2 to 3 weeks were now being quoted at April, even May 2026. That's 3 to 4 months out, for a commodity that trades millions of ounces daily on paper exchanges. Bullion Star, one of Asia's largest precious metals dealers, released an internal memo that would later become public. The language was telling. We are actively sourcing whatever silver remains available in the market. Read that carefully. Not negotiating favorable pricing, not managing delivery schedules, sourcing whatever remains available. This is the language of scarcity. Real scarcity. Meanwhile, data from the Shanghai Gold Exchange told an even more alarming story. On January 28th, the SGE silver vaults held 507 metric tons of physical silver. On January 29th, that number dropped to 480.64 metric tons. A single-day withdrawal of 26.36 metric tons. That's a 5.8% decline in total vault inventory. Overnight, to put this in perspective, the week prior, from January 19th to January 23rd, the SGE vaults had seen a drawdown of just 1.53 metric tons over 5 trading days. Now, in one 24-hour period, withdrawals were running at 17 times that weekly rate. This wasn't speculation. This wasn't algorithmic trading. This was physical offtake. Large buyers, Manufacturers, institutions, perhaps even sovereign entities were taking delivery and removing metal from the exchange system entirely. The technical picture confirmed what the fundamentals were screaming. Silver had broken through its previous all-time high of $49 set back in 2011. It had consolidated briefly around $100 and then entered what traders call price discovery. This is the zone where an asset trades above all historical resistance levels, where there are no previous price points to guide valuation, where the market must determine in real time what the asset is truly worth. The 21-day moving average, a key technical support level, now sat at $97. Just 6 months earlier, the idea of silver trading near $100 would have seemed fantastical. Now it was the support floor. Volume analysis showed something equally significant. Massive accumulation had occurred in the $90 to $100 range. This suggested that large players, institutions with deep pockets and strategic mandates, had been positioning, not speculating, positioning. And here's what made this different from every previous silver rally. In 1980, when silver hit $49, it was driven by the Hunt brothers attempting to corner the market. That was speculation. In 2011, when silver again touched $49, it was part of a broader commodity supercycle fueled by quantitative easing. That was monetary expansion flowing into hard assets. But this was different. The paper market was saying one thing. The physical market was saying something entirely different. Comics traders could buy and sell silver contracts all day at $120. But in Shanghai, where physical delivery actually mattered, where metal had to change hands, where promises had to be kept, the price was $138. And climbing, this is what market participants call a dislocation. When two markets for the same asset trade at fundamentally different prices, and the mechanisms that normally force convergence have failed. The arbitrage wasn't broken because traders didn't see the opportunity. It was broken because the physical silver needed to execute the arbitrage didn't exist, or couldn't be moved, or was being held by entities who had no intention of selling, regardless of price. The global silver market, a market worth hundreds of billions of dollars, was fracturing in real time, and the fracture line ran between paper promises and physical reality. What happened next would determine whether this was a temporary disruption or the beginning of something far more significant. To understand what was truly happening, one had to look beyond the price charts, beyond the headlines, and examine the physical infrastructure that makes the global silver market function, because something fundamental had broken. And it wasn't just about supply and demand, it was about the architecture of the market itself. The global silver refining industry operates on a scale most people never consider. There are only a handful of facilities worldwide capable of refining silver to the 999 fine purity required for investment-grade bars: Perth Mint in Australia, Metalor in Switzerland, Arger Heraeus in Switzerland, Valcambi in Switzerland, Pamp Suisse in Switzerland, the Royal Canadian Mint. These aren't startups. These aren't operations that appeared last decade. Perth Mint was established in 1899. That's 127 years of continuous operation. Metalor has been refining precious metals since 1852, 174 years. These are institutions with deep supplier relationships, with established logistics networks, with reserve capacity built into their operations. For all of them to simultaneously announce they cannot accept new orders, that's not a logistics problem, that's a structural failure. And here's what makes it even more significant. Silver mining doesn't work the way most people think. You can't just decide to mine more silver when the price goes up. Approximately 70% of global silver production comes as a byproduct of mining other metals: copper mines, lead mines, zinc mines. Silver is extracted during the refining process of these base metals. This means silver supply is largely inelastic. If copper demand is stable, copper mining continues at the same rate, and silver output remains constant, regardless of silver prices. In the short to medium term, meaning the next 12 to 18 months, global silver production is essentially fixed. It cannot respond to price signals. Meanwhile, demand was accelerating in ways that were structurally different from previous cycles. The Silver Institute, the industry's primary research organization, had published data showing record industrial silver consumption in 2024 and 2025. But this wasn't demand that would reverse when prices rose. This was structural demand. China alone was installing solar photovoltaic capacity that required over 100 million ounces of silver annually. Every solar panel contains silver. It's used in the photovoltaic cells that convert sunlight to electricity. There is currently no substitute that matches silver's conductivity and efficiency. And here's the critical point. Once silver is embedded in a solar panel, it's gone for 25 years. It doesn't return to the market. It's not recycled. It's locked into infrastructure. The same applies to electronics, 5G infrastructure, electric vehicle components, medical devices. This silver isn't being hoarded by speculators who might sell if prices rise. It's being consumed permanently. And the consumption rate was increasing, not decreasing. Now, layer in what was happening in China specifically. The Chinese government had been strategically accumulating gold reserves for over a decade. This was well documented. But silver had quietly become a strategic metal for China, not just for monetary reasons, but for technological sovereignty. China controls a significant portion of global silver refining capacity. And in recent months, the government had begun implementing export restrictions on certain silver compounds used in advanced electronics and defense applications. When a government restricts exports while domestic prices surge 15-20% above international levels, that's not market inefficiency. That's strategic policy. The 18-plus premium in Shanghai wasn't irrational. It was revealing. In traditional market theory, arbitrage opportunities create their own solution. Traders see the price gap, they exploit it, the gap closes. But arbitrage requires three things. First, the ability to buy in the cheaper market. Second, the ability to physically transport the asset. Third, the ability to sell in the more expensive market. On January 29, 2026, the second requirement had failed. Physical silver could not be sourced in sufficient quantities to close the gap. New York traders could sell COMEX contracts all day, but those were paper promises. In Shanghai, buyers wanted physical metal, actual bars, delivered to vaults, and the metal wasn't there. Or more precisely, the entities who held physical silver had no interest in selling it to arbitrageurs at $120 when Shanghai buyers were willing to pay $138. This created a feedback loop. As physical metal moved east, Western vaults depleted. As Western vaults depleted, refining backlogs grew. As backlogs grew, premiums increased. As premiums increased, more metal moved east. The cycle was self-reinforcing. Wholesale dealers, the intermediaries between refiners and retail dealers, were experiencing something unprecedented. Premiums that normally ran 2-3% over spot prices had spiked to 100 to 200% over spot in just 48 hours. A dealer who might normally pay $120 for a silver bar when spot was $120 was now being quoted $240 to $360 if they could find available metal at all. The language in internal communications was shifting from price negotiation to availability search. This is the difference between a functioning market and a broken one. In a functioning market, everything has a price. In a broken market, some things simply aren't available, regardless of what you're willing to pay. European refiners were quoting April and May delivery dates. It was late January. That meant buyers placing orders today wouldn't receive metal for 3 to 4 months. For a commodity that trades with 2-day settlement on futures exchanges, this was extraordinary. The physical market and the paper market had completely divorced. One was trading on promises, the other on reality. And reality was becoming increasingly scarce. The Shanghai vault drawdown of 26 metric tons in one day wasn't just a number, it was a signal. Large, sophisticated buyers were taking delivery, removing metal from the exchange system, and holding it. This wasn't speculative positioning that would reverse when prices corrected. This was accumulation, strategic accumulation, and it was accelerating. But silver wasn't moving in isolation, and that's what made this moment fundamentally different from every previous rally. Gold was surging simultaneously. On the same day, January 29th, 2026, gold closed on the Shanghai Futures Exchange at $1,249.12 per gram. That translated to $5,190.20 per ounce, up 7.888% in a single session. When both gold and silver surged together, when vault inventories of both metals drain simultaneously, when refining capacity for both becomes constrained at the same time, the market isn't signaling a commodity trade. It's signaling something far more profound, a loss of confidence in the monetary system itself. Think about what money actually is. At its core, money is a claim on future resources, a promise that the piece of paper in your wallet or the digital entry in your bank account can be exchanged for real goods and services. That promise only holds value as long as people believe it will be honored. And belief requires trust. Trust in governments, trust in central banks, trust in the stability of the currency, But what happens when that trust begins to erode? People don't announce it. They don't hold press conferences declaring they've lost faith in fiat currency. They simply act. And the action is always the same throughout history. They move into assets with intrinsic value, assets that cannot be printed, assets that exist in finite physical quantities, gold, silver, real estate, commodities. This is what was happening in real time across global markets. But here's where it got more complex, because not all buyers were created equal. The retail investor buying 10 ounces of silver online was one thing, but the data suggested something else entirely was driving this move. The 26 metric ton single-day withdrawal from Shanghai vaults represented approximately 837,000 ounces. At $138 per ounce, that's $115.5 million worth of physical silver. Removed in one day by one or more entities, retail investors don't move in those quantities. This was institutional, possibly sovereign, and they weren't buying paper contracts. They were taking physical delivery, which meant they didn't trust the promise. They wanted the metal. The macro backdrop made this behavior rational, even predictable. Since 2020, global sovereign debt had exploded to levels never before seen in peacetime. Central banks had expanded their balance sheets by trillions. The US Federal Reserve, the European Central Bank, the Bank of Japan, the People's Bank of China, all had engaged in unprecedented monetary expansion. In traditional economic theory, this should have caused immediate inflation. But for years, that inflation didn't materialize in consumer prices the way textbooks predicted. Instead, it showed up in asset prices, stock markets hitting record highs, real estate prices surging, bonds trading at negative real yields. But by late 2025 and early 2026, something had shifted. The inflation that had been contained in financial assets was beginning to leak into the real economy. And more importantly, people were starting to notice. When citizens notice currency debasement, they change behavior. They stop saving in cash. They stop trusting long-term bonds. They seek stores of value that cannot be debased by monetary policy. This is where gold and silver enter the equation. But there was another factor amplifying the move: the rise of algorithmic trading. By 2026, an estimated 70 to 80% of trading volume on major exchanges was executed by algorithms, high-frequency trading systems that could execute thousands of trades per second. These systems are extraordinarily efficient at exploiting tiny price discrepancies. A 1-cent difference between two exchanges, an algorithm would spot it and exploit it in microseconds. But algorithms have a fundamental limitation. They can only trade what physically exists. And herein lay the critical failure point. In the paper, silver market, futures contracts, ETFs, unallocated accounts, algorithms could trade freely, contracts could be created and destroyed with keystrokes, no physical metal needed to change hands. But when actual physical delivery was required, when someone said, "I want the actual metal, not a promise," the algorithm couldn't conjure silver into existence. This is why the Shanghai premium persisted. Chinese buyers were demanding physical delivery. Western markets were trading paper promises. And the physical metal needed to bridge that gap didn't exist in accessible form. History provided a disturbing precedent. In March 2022, the London Metal Exchange experienced a crisis in nickel trading. Prices had spiked dramatically due to supply concerns following geopolitical events. Some traders who had sold nickel contracts, promising to deliver physical metal, suddenly could not fulfill those promises. The LME made an extraordinary decision. They canceled trades, they halted the market, and they allowed forced cash settlement instead of physical delivery. Traders who had been promised nickel received cash instead, at prices far below what the market was actually trading. This was a breakdown of contract sanctity, a recognition that the paper market had made promises the physical market couldn't keep. Could the same thing happen in silver? The mechanisms existed. COMEX had provisions for cash settlement under extraordinary circumstances. Major silver ETFs had legal language allowing them to settle in cash rather than metal under certain conditions. Unallocated silver accounts, where investors owned a claim on silver but not specific bars, had similar provisions. If the physical shortage deepened, if delivery demands exceeded available supply, exchanges and institutions had legal pathways to declare force majeure, to suspend physical delivery, to settle in cash. This was counterparty risk in its purest form, the risk that the entity promising you silver wouldn't or couldn't actually deliver it. And here's what made the current situation particularly precarious. Nobody knew the true depth of physical silver inventories. COMEX reported vault stocks. The LBMA reported holdings. But those numbers represented what was reported, not necessarily what was available, because available is different from existing. Silver sitting in a vault might be allocated to specific owners who had no intention of selling, pledged as collateral for financial transactions held by long-term strategic buyers, committed to industrial delivery contracts. The amount of silver that could actually be mobilized to meet new demand at any price was fundamentally unknown. This information asymmetry created vulnerability. Markets function on transparency. When transparency breaks down, price discovery fails. And when price discovery fails, wild volatility follows. The Chinese government's behavior suggested they understood this. Export restrictions on silver compounds, tolerance for elevated domestic prices, strategic accumulation. These weren't the actions of a government concerned about a temporary price spike. These were the actions of a government securing strategic resources for a future they saw coming that others perhaps didn't or wouldn't acknowledge. The convergence was complete. Macro-monetary instability, structural supply constraints, strategic sovereign positioning, algorithmic trading limitations, counterparty risk in paper instruments, all pointing in the same direction, toward a repricing of physical metal versus paper promises. The question wasn't whether this was happening. The data confirmed it was. The question was what happened next, and whether Western authorities would intervene to suppress it, or whether the physical shortage would overwhelm any intervention attempt. Every major market move creates two narratives, the bull case and the bear case, and the truth is, both are usually partially correct. Markets don't move in straight lines, they don't respect neat predictions, and anyone claiming certainty about what comes next is either ignorant or dishonest. So let's examine both sides with equal rigor, because intelligent decision-making requires understanding what could go wrong, not just what could go right. The bearish case had a legitimate foundation. First, exchanges had tools to halt speculative rallies. The CME, the exchange that operates COMEX, could raise margin requirements. They had done this before. In April and May 2011, when silver was surging toward $50, the CME raised margin requirements 5 times in just 9 days. Each increase made it more expensive to hold speculative positions. Traders who were leveraged were forced to either deposit more cash or liquidate their positions. The effect was immediate and brutal. Silver collapsed from $49 to $32 in a matter of days, a 35% decline. Those who had bought at the top were devastated. The same mechanism existed in 2026 and could be deployed at any time. Second, central banks had options. Coordinated swap lines could be established. Emergency leasing programs from sovereign reserves could be announced. The psychological impact alone could reverse the rally. History showed that when major central banks acted in coordination, markets listened. The question was whether they would, and whether physical shortages had progressed to a point where such interventions would be effective. Third, this could simply be a blow-off top, a parabolic price move driven by momentum and fear, the kind that attracts late-stage buyers who pile in at the worst possible moment, right before the collapse. Technical analysis showed that parabolic moves, where prices rise almost vertically, rarely sustain. They typically end in violent reversals, the kind that shake out 80-90% of recent buyers. If silver had reached $120 on speculation rather than genuine physical shortage, a correction to $70 or $80 wasn't just possible. It was probable. Fourth, the Shanghai premium could narrow quickly. If Chinese authorities imposed capital controls, if they restricted imports, if they jawboned the market with official statements, that $18 gap could disappear in days, and with it, the narrative of unstoppable demand. Fifth, algorithmic trading systems could trigger cascading liquidations. If broader risk sentiment shifted, if stock markets corrected sharply, if a geopolitical event caused flight to cash, systematic selling could overwhelm physical buying. Algorithms didn't care about fundamentals. They responded to momentum, and momentum could reverse as quickly as it had built. Sixth, and perhaps most important, nobody had complete transparency into global silver inventories. Off-market supplies could exist. LBMA vaults in London held silver that wasn't fully disclosed. Private vaults operated by major banks, strategic reserves held by governments, industrial stockpiles held by manufacturers. If just a fraction of this hidden supply came to market, it could satisfy demand and collapse premiums overnight. These weren't theoretical risks. These were real, documented mechanisms that had worked before. Anyone ignoring them was gambling, not investing. But, and this was a significant but, the bullish case had also strengthened in ways that were difficult to dismiss. Perth Mint wasn't a marginal player. It was a 127-year-old institution backed by the government of Western Australia. For them to halt new orders suggested something beyond temporary logistics. This was a structural acknowledgement that they couldn't source metal. Metalor's simultaneous halt confirmed it wasn't isolated. When multiple century-old refiners make the same decision at the same time, that's a signal. The 100-200% spike in wholesale premiums wasn't normal volatility. That was a repricing, a fundamental shift in the relationship between paper and physical. Dealers who had operated for decades were using language they'd never used before, actively sourcing whatever remains available. This wasn't negotiation. This was scarcity, real scarcity. The April-May delivery timelines from European refiners told the same story. 3 to 4 months for refined silver. In an industry where 2-week delivery was standard, this wasn't a backlog. The Shanghai premium widens further. Paper markets lose credibility entirely. Forced cash settlements begin occurring. Physical silver becomes genuinely unavailable at posted prices. Prices move toward $150, $180, potentially higher, as the paper market completely decouples from physical reality. In this scenario, the market isn't trading on fundamentals anymore. It's trading on panic and scarcity. Which scenario unfolds? Nobody knew. Not the analysts, not the institutions, not the governments. Because markets under stress don't follow predictable patterns. They evolve based on decisions made by thousands of participants, each responding to incomplete information, each trying to position for an uncertain future. But here's what could be said with confidence. The risk-reward had fundamentally shifted. 6 months earlier, buying silver at $30 meant risking 15-20% downside to potentially gain 100 to 200% upside. That was asymmetric opportunity. Now, buying at $128 meant risking 30 to 40% downside to potentially gain another 25 to 50% upside if prices reached $150, $180. That was not asymmetric. That was gambling on continuation. For those who had bought at $20, $30, or $50, this was decision time. Take profits and lock in life-changing gains. Hold through volatility, betting on further upside. Take partial profits and let the rest run. There was no universal answer, because each person's situation was different. Their risk tolerance, their time horizon, their need for capital, their conviction in the thesis. But one thing was clear. If profits were to be taken, a plan was needed, not an emotional reaction to daily price swings, but a predetermined strategy, written down, committed to in advance. I will sell 25% if price reaches $140. I will sell 50% if Shanghai premium collapses below $5. I will sell everything if vault inventories stabilize for 3 consecutive weeks. Whatever the trigger, it needed to be defined before emotion entered the equation. For new buyers considering entry at these levels, the calculus was different. Buying at all-time highs meant accepting substantial downside risk. If the blow-off scenario played out, losses could be severe. Dollar-cost averaging made more sense than lump-sum deployment. Spreading purchases over 3 to 6 months, buying increments on weakness rather than strength. This approach provided participation if prices continued higher, but avoided catastrophic exposure if correction came. And then there was the counterparty risk, the risk that separated the sophisticated from the naive. Paper silver came in many forms. ETFs like SLV that claimed to hold physical silver, COMEX futures contracts promising delivery, unallocated accounts at banks and dealers. All of these were contractual promises, not ownership. In normal markets, that distinction didn't matter, but in dislocated markets, it mattered enormously. The London Metal Exchange nickel crisis of 2022 proved it. When physical delivery became impossible, at prices far below market, holders of paper nickel got paid, but not what they were owed. The same mechanisms existed in silver markets. Force majeure clauses, cash settlement provisions, regulatory emergency powers. If Perth Mint wasn't accepting new orders, what happened to existing unallocated certificate holders who wanted to convert to physical? They might get cash, but would they get metal? That question hadn't been tested yet, but the test might be coming. For industrial users, manufacturers who actually needed silver for production, the situation was critical. Waiting until April or May for delivery meant production delays. Missed contracts, revenue loss, hedging strategies needed immediate review. Forward contracts needed to be secured while still possible. Supply chain diversification was no longer optional. 3 concrete realities had emerged. First, the physical and paper markets had decoupled. The $8 premium with zero arbitrage proved it. Second, refining infrastructure had broken down. Or 1980,